In 2004, the United Nations introduced a new term called the ESG, which describes the factors that can be used to measure the non-financial impact of a company. ESG, or expanded as environmental, social, and governance, pertains to several points such as how companies respond to climate change and adaptation to the environment, how they treat their employees, how to manage supply chains, as well as corporate governance. ESG is the company's strategy to ensure the sustainability of the company through the integration of ESG risk and opportunities in the bank's business, operations, and human capital management. Focus on three pillars, namely planet, people, and prosperity or profit. Create a competitive advantage that has the potential to attract socially responsible investment, both funding and share ownership, and other business potentials in the future. In order to become a sustainable company, the company must not only focus on increasing profits, but is also expected to be a company that is also environmentally friendly, socially responsible, and well managed. The implementation of ESG in investment management and ESG asset under management is on an upward trend. In 2016, asset under management global ESG showed a figure of $22.9 trillion, and in 2020, it has almost doubled up to $40 trillion. In practice, the ESG regulatory policy is regulated in POJK number 51 of 2017, which contains the implementation of sustainable finance for financial service institutions, issuers, and public companies. BNI has become the first mover in starting a sustainable ESG business, having done so since 2017. The following are the measures that have been taken by BNI to achieve this goal of sustainability: eliminating hunger, achieving food security and good nutrition, also promoting sustainable agriculture, ensuring access to affordable, reliable, sustainable, and modern energy sources for everyone, building inclusive, safe, resilient, and sustainable cities, taking urgent action to combat climate change and its impact. Furthermore, starting from 2019 and until 2023, BNI has been implementing a Phase 2 ESG roadmap by executing several things, namely, the determination of KKUB based on the palm oil sector and renewable energy in the banking business segment program, a sustained financial assessment and implementation of renewable energy, the implementation of sustainable finance and management of forest resources, a sustained financial assessment and implementation in manufacturing, food and beverage industry, the implementation of sustainable finance in the manufacturing, food and beverage industry. The sustainability commitment of BNI is carried out to support the achievement of development goals through 5 pillars. This is stated in the blueprint of the Board Directors' Decree number KP/412/DIR/R dated December 4, 2018 regarding the 2019 Sustainable Finance Action Plan or RAKB. It should be noted that the pillars and strategies of BNI have 5 important points that are put forward by adjusting the core of ESG. BNI for Indonesia, BNI for customers, BNI for the environment, BNI for the community, and BNI for employees. To support the success of this program, let's start by becoming someone who also cares about the environment, society, and Indonesia. Let's race!
Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera bagi kita semua. Om Swastiastu, Namo Buddhaya, salam kebajikan. Segala puji bagi Tuhan Yang Maha Esa yang telah memberikan karunia hari ini kepada kita sehingga kita dalam keadaan sehat. Sebelumnya kami mengucapkan selamat atas penyelenggaraan acara ini. Kami dari BNI Corporate University merasa sangat terhormat dan diberikan kepercayaan untuk mensupport acara ini. Semoga dapat berjalan lancar hingga akhir nanti. Amin. BNI Corporate University bukan hanya memberikan pelatihan atau pembelajaran di bidang jasa keuangan, tapi juga memberikan edukasi kepada seluruh nasabah setia BNI, yaitu program yang memberikan manfaat serta berguna untuk kita semua. Antara lain, informasi mengenai kesehatan. Kami juga memberikan pengetahuan tentang psikologi serta parenting bagi orang tua maupun calon orang tua. Selain itu, ada juga edukasi mengenai happiness, membangun mental tangguh, dan lain-lain. Ada juga edukasi untuk mengatur keuangan masa depan, dan masih banyak program lainnya. Selamat menikmati persembahan kami. Wassalamualaikum warahmatullahi wabarakatuh.
Good afternoon, ladies and gentlemen. Hello, BNI High Movers. Welcome to ESG Trends and Market Outlook, presented by Enterprise Risk Management Division and BNI Corporate University. I'm your host, Darman. So first of all, this event is implementing a very strict COVID rules to prevent its spread. So, for example, the antigen test and etc. So first of all, let me take off this mask first. Today is arguably one of the best days to talk about ESG and market outlook because so many experts say that we are at the epicenter of what is called the perfect storm. The COVID-19 and its new variants have emerged, and also the inflation that can lead to stagnation. And we don't even talk about the geopolitical pressures all around the world. For example, the war in Ukraine and also the tension between China and Taiwan. But that's exactly the reason why Bank Negara Indonesia is initiating this event to talk about it. We already invited 3 special guests from Moody's Analytics to talk about this. And we introduce them to you just soon enough, so be patient with us. Before we continue, let me inform you that this event will be fully run in English. If you're interested to watch it in Bahasa, then you can check on the description of the YouTube video that you're watching right now, and you'll be directed to the second stream of the YouTube. Okay. So BNI High Movers, it's time to learn, so focus yourself and prepare the best question in every session. Without further ado, let's start this event by inviting the Director of Risk Management of Bank Negara Indonesia, Mr. David Pirzada.
Thank you, Pak Darman. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon and peace be with all of us. Om Swastiastu, Nama Budaya, Salam Kebajikan. To our honorable speaker, Mr. Stephen Cochrane, which is the Chief APAC Economic Solutions from Moody's Analytics. Ms. Joel Bautista, Head of Climate Risk Solution, Moody's Analytics, and Mr. Dimitrios Papanastasiou. I hope I can spell it right. And also to Pak Rayendra as a GM of ERM of BNI, all head of divisions who attend this seminar in person through Zoom application, and to all BNI high movers who follow our program through Korpu TV YouTube channel. I would like to extend my gratitude to Moody's analyst team for giving us a sharing session related to the market outlook and sustainable finance trends based on environmental, social, and governance, or ESG. As we know, ESG is currently a hot topic and has become an urgency that we must immediately follow up by developing awareness and commitment through concept and policies development as company performance standards, and then implement them in the company's daily basis operations. BNI, as one of the national banks, must be able to play a key role in promoting more responsible and sustainable business practices, business practice that takes environmental, social, and governance factors into considerations in making investment decisions and also the company's decision-making process along with conventional financial calculations. So BNI's role here is to become one of the agents of transformation in the implementation of ESG to support sustainable finance. The biggest challenge for BNI is to convince business actors and the public that taking natural resources and their social impact on the community into account will make the efforts to generate profits much better and sustainable. This is the true 3P principle of profit, people, planet, which is one of the guidelines for BNI to increase awareness and literacy regarding ESG. Then after that, we can proceed with creating the necessary infrastructure so that a sustainable financial ecosystem can be formed. Let me a little bit explain about what BNI has done on the ESG. BNI's green portfolio is currently classified based on 12 categories of sustainable business activities, or CSPA. As of May 2022, the total category of sustainable business activities of the total loan portfolio is 28%, or around 168 trillion IDR, which is currently still dominated by MSME, which is small medium enterprise activities of around 113 trillion IDR. Beside MSMEs, the next largest activities are natural resources control, which reach around 14.8 billion, or around 9% of the total CSBA, and energy efficiency activities, which reach around 14 trillion IDR, or around 8% of the total CSBA. So in conducting monitoring and evaluation, one of the indicators we currently use is the ESG rating from the MSCI, or Morgan Stanley Capital International, where our current rating, BNI rating, is a single A, which is the highest rating among Indonesian banks. So we should be quite proud on this rating. BNI also recently issued a green bond, which is worth around 5 trillion IDR, which was developed based on 4 guidelines principles in green bonds, where the proceeds will be used to facilitate projects in the environmental business activities category to help the transition to low carbon economy in Indonesia. BNI has also obtained a rating for these long-term debt securities from Pevindo for the period of March 8 until for 1 year. Excuse me, with a rating of ID AAA, which is the highest rating. So from the book building that has been carried out, there have been oversubscribed by 4 times, which is indicated that investor appreciation toward BNI's commitment. Sorry, excuse me. It's quite a high appreciation for BNI's commitment to sustainability finance is quite high. And also we should note that the BNI Green Bond is the first green bond issued by a bank in Indonesia, and also the first largest domestic green bond issued by a corporation in Indonesia. So these milestones are quite a good achievement that must be maintained and improved. Strong ESG management will become an important key in the sustainability of a company. However, the current global economic condition has also a high level of uncertainty in the midst of the turmoil of Russian-Ukrainian war, and also on the condition of the global economy with high inflations. So, although Indonesia has recorded economic improvement throughout 2021 until now, we must also be responsive and alert to the unexpected turn in the recovery of economy, both in a national and global scale. So to end my opening, once again, on behalf of BNI, I would like to thank you for holding this webinar, and hopefully through this forum, efforts to improve business and operational performance on an ongoing basis can be carried out consistently to support the achievement of our business targets. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much, Mr. David. Okay, Benny Heimopers, you must be waiting for the main course of today's event. We're heading to that point. So the next session would be the discussion about the ESG trend, and it will be guided by the General Manager of the Enterprise Risk Management Division. Ladies and gentlemen, please welcome Mr. Rayendra M. Goenawan.
Assalamualaikum warahmatullahi wabarakatuh. Selamat siang dan salam sejahtera bagi kita semua. Om Swastiastu, Namo Buddhaya. Salam kebajikan. Echoed what Pak David have already mentioned, I would like also to welcome, first of all, our Honorable Risk Management Director, Pak David Pirzada, who has also supported this event, and also to welcome our distinguished speaker, Ms. Jewel, and also Mr. Steve Cochrane, and also my good friend Arvin from Moody's. I would like also to greet all the participants on site and also joining online, via online. And also I would like to thank our team, Enterprise Risk Management, who has also coordinated this event. Okay, for prolonging these discussions, we can also open the mask. As we all know, all the protocols for COVID have already been proceeded. And hopefully all is already in negative, yeah? Even though the conditions is not that convenient at this point. Today's event, we will focus on the emerging development on global trends. Environmental, social, and also governance, or ESG in short, has been the talking points around the world. The necessity has increased around the globe, including in Indonesia itself. As we speak, there are numerous investors and also entities keeping tabs on how Indonesia is planning and also how Indonesia is trying to do regarding the implementation of the ESG standards itself. There are also countless opportunities arise based on the implementing the ESG principles. At the point, the focus to have a sustainable finance is people, profit, and also planet. As what Pak David have already mentioned, this is the guidelines and the standard that BNI is already put in track. It has to strike a balance between the implementation of the ESG principles and also the deliverables and the contribution based on the performance, including people enhancement. As we are gradually building the portfolio, aspects of focus on ESG deliverables will increase the prudent approach for an effective implementation. Therefore, the event will also cover the best practice of how the risk management approach can optimize the implementation of these principles itself, and also bear in mind to leverage how the business orientations can also reap the benefits on the ESG principles, and also to push how we can grow the portfolio sustainably. Our distinguished speaker, Ms. Jewel, has a vast experience in the ESG implementation as the subject matter experts from the Moody's, and also the subject matter expert also in credit risk assessment. The climate risk management across Asia Pacific and also the Middle East have already been supported by Ms. Jewel itself. Hope you all enjoyed the event. Without further ado, please, the floor is yours, Ms. Jewel.
Thank you so much, Pak Ray. So, selamat siang, Ibu dan Papa. So I hope I got that right, and I'm still trying to get around my bahasa. So it is an honor to be representing Moody's Analytics and to be part of your event, and thank you very much for inviting us. So basically what I wanted to do today is maybe just to set the scene in terms of us coming in and representing the entire Moody's Corporation. So we just wanted to try to understand that Moody's Corporation in general have already transformed into a much more global type of integrated risk management. So as opposed to a few years ago, whereby we are more focused on credit risk in general. So we already are taking care of looking into those type of emerging risks as part of Moody's Analytics. So what we have done in terms of ESG, in terms of climate risk, is that we have taken it seriously, and it's within the core of the business. So that means that we have actually built a separate unit within Moody's Corporation, that their primary objective is to provide a consistent view of ESG data, of ESG physical and transition risk type of information, and the type of analytics that would be required, that is being leveraged both by the investor service, which is the rating agency arm of Moody's Corporation, and us in Moody's Analytics, which provides the risk and finance solutions to our clients and to BNI as well, in terms of the partnership that we are having that is ongoing at the moment. So what I would probably like to do is that in terms of the key themes, right? So what are we seeing in terms of the key industry movement and the way that the financial industry is looking at ESG and climate risk in general? So there has been a huge shift in terms of how we perceive this type of risk that we are facing right now. So what that means is essentially there are new challenges that actually arises, and BNI being the first bank in Indonesia that have taken quite a fair bit of steps in terms of managing this type of risk can actually relate in terms of what are the types of you in the risk department would actually be facing at the moment. So the type of information that you would need to gather is monumental in terms of being able to achieve that new information. So banks, for example, are being faced with regulatory pressure. They're being faced with disclosure requirements, and this is on top of the current policies, the current guidelines that you are currently doing as part of your business as usual. And when we talk about disclosures, this primarily revolve around data and new type of information, whereby both the company that you are going to get into business with and the bank yourself is not primarily obtaining. So these are not the traditional type of data like financial information that you would require to do a full ESG assessment, right? So these kind of things are very much driven by the type of information that you would have. And what that means for a bank is that you need to look into it on a perspective of it being a financial risk. So I think we have recognized in the industry, in the Asia Pacific region, that this is something that carries a financial impact. So that particular issue is that there is where the key challenge would rely, whereby how would you be able to quantify the impact of ESG, the impact of climate risk, and translate that into a financial impact beyond reputational risk, beyond the operational risk that a company is facing. How do you actually do this? And that boils down into the methodology, into the capability of the bank being able to do the assessment. So when we're doing the ESG assessment, we're talking about new capabilities, and this surrounds about having the right data, having the right methodology or the approach to be able to do that particular assessment, and trying to identify what are your key challenges and how do you able to quantify that and determining a process from risk identification to all the way to risk quantification. So having said that, last but not the least, is that one of the key things is that there is an expectation. There is an overall expectation in terms of the change into the customer expectation, investor relations that have already, because there is an increased awareness on ESG, the investor expectation have also increased quite a lot. So it's primarily driven by the fact that if you wanted to obtain a lot of investor practices and to be able to obtain both on the local market and on the global market as well, the expectation there is quite huge. So there are a lot of considerations and nuances that needs to be taken into play. And that's where actually we wanted to take a look as to what is happening in the world today in terms of ESG and climate risk. So when we're looking into the behavior of how the regulators are taking part in terms of ESG, how are they, the commonalities across this is that all of the regulators do or have issued certain guidelines. They have issued certain framework, but if you look into them into a holistic manner, there are actually 3 key themes that they're emphasizing in terms of those regulations that they have put forth. So the first one being the best practice in terms of incorporating climate risk into the overall risk management framework. So that's the first key thing that you need to learn from each other as to what are how are you going to incorporate climate risk and ESG within your overall risk governance process. And there is another one which is surrounding about disclosure. So disclosure beyond the regulator, even the stock exchanges in the respective country have also mandated those corporates that are listed under them should have to comply within a TCFD kind of a gold standard type of a disclosure, so that each of the investors would have a comparable type of resources or a comparable type of an analysis to be able to compare you from the other. And last but not the least is talking about scenario analysis, talking about stress testing. And looking into one of the neighboring countries in Indonesia, so Singapore right now, the Monetary Authority of Singapore have actually started to do their stress testing in terms of climate. And they are expecting the financial institutions in the country to be able to do that compliance by Q3, which is September 2022. And if you look into it, like the guideline was only announced in 2020, late 2020. And then they have already managed to come out with their own MAS scenarios to be able to do that particular quantification and for the financial institutions to actually be able to quantify the risk in terms of ESG and climate. And it's, I think, only a matter of time before OJK also come out with something. So I do know that OJK has already come out with the green taxonomy and that they are already in phase 2 of the sustainable roadmap. And I think for BNE, it's already momentous in terms of what you have taken in terms of that particular process. So it's only a matter of time that probably, hopefully, there would be certain guidelines, because I think not a lot of the banks have the maturity in terms of being able to adopt what the entire financial industry is actually taking without a proper framework coming from the regulator itself, right? So those kind of things are looking into the particular trend. And obviously, when we're talking about ESG, when we're talking about climate risk, one of the key questions that we always get is, what's the difference? What is the correlation between ESG and climate risk in general? And what is exactly the impact that you're talking about? So there are a lot of discussions surrounding it, but what you can see probably on the slide right now is, maybe I'll just summarize it in the interest of time, but what you can see here is that climate change is impacting us on different transmission channels. So that means that it is primarily driven by both the physical risk and the transition risk. So when we're talking about physical risk in general, that is quite straightforward. So you're talking about whether it's an acute weather event or a chronic type of weather event, then that is quite straightforward because it can cause disruption to the business. And when you have that particular issue, of course, that would mean that there would be a decrease in productivity, which would entail or carry certain type of credit risk, certain type of operational risk to that business. Now, looking into the transition risk, on the other hand, is primarily talking about changes in policy. So let's say you have the carbon taxes in play, and then you have shift in the consumer preferences, and all of these are being driven to drive the cost up. And that would entail that there would be changes in energy prices, which is a prime commodity and so on. So that would carry a certain amount of risk as well towards credit, towards reputational, towards operational risk. So all along that, the main common feature of that particular risk is that these are external. These are external to the company that you're trying to assess. But when you look into ESG in particular, what you wanted to look at is that what is this company doing in terms of physical risk, in terms of transition risk. So it's more on an internal drill down assessment of the company's prime activity. What are the steps that they are taking? And if you look into them all together, it's actually complementing or interlinked. So the transition and physical risk being on a macro type of level of an impact, while the ESG is coming from the company itself. And when you're doing the scenario analysis type of an assessment, when you look into the catalyst of physical and transition risk, these are primarily forward-looking in nature and longer term in horizon. But ESG is primarily looking at right now. It's more on point in time, what is the type of operations that you're doing, and what are the strategies that you have in play, and so on. So they are different, but at the same time, they are related to each other. And we have talked about disclosures earlier. I did mention about the Task Force for Climate-Related Financial Disclosures. And one key thing to note on TCFD is that this is the gold standard of reporting. So they are the one who have come about with a particular framework that they are requiring the companies to be able to follow certain type of pillars. So meaning they are expecting the companies to be able to define their KPIs, their metrics, their targets, and at the same time be able to incorporate that in their own risk management, governance, and strategy. So TCFD is where the regulators are also pointing towards. So they are telling, they are mandating, and even let's say in New Zealand or in Bank Negara, Malaysia have already said that this is mandatory to follow the TCFD type of a framework. And if you look into the overall progression that we have globally, so we in Moody's, we are actually part of the task force. And when we look into the data that we have, is that there had been certain movements, right, for the TCFD. So in terms of the global assessment, if you do a comparison between 2020 and 2021, there had been a lot of progress with regards to being aligned to TCFD type of a disclosure, and each of the industry reacts differently, and they have actually complied differently. So with the data set that we do have, you can see that both the energy and the financial sector are quite advanced in comparison to the other industry, but there is still a lot of work that needs to be done, and particularly focusing on the risk management part of TCFD, you can only see that only 12% of the company are actually aligned to what TCFD have recommended to follow. So we have made progress for sure, but there's still a lot more things that we need to do to be able to do that complete picture in terms of doing the disclosure, in terms of being able to actually be at that point whereby we are considered to be fully compliant with the task force. And maybe some of the examples of the matrices. So this is not a one-size-fits-all kind of thing. Different companies, different industries would actually require different types of metrics, different types of KPIs and targets, right? But it would primarily revolve around certain core key building blocks. So you have physical risk, you have the carbon emissions, you have the climate scenarios in play, and all of these things you can already complement with the analytics so that you can quantify and translate what these particular exposure mean in terms of the different climate scenarios, and then what does that mean to the viability of the company that you're doing. So what that primarily signifies is that taking, for example, the work that we have done with Bank of England. So Bank of England is the regulator in Europe, and what we have done is that they have actually published their disclosure as of June 2021 last year. And one of the key things here is that they have leveraged Moody's to be able to provide them with the data and the information and help them do the assessment of their physical risk exposure within the entire European region. So that says a lot, because beyond the assessment of the actual risk, they also did leverage in terms of the forward-looking assessment to do the quantification of the financial impact. Meaning, once they have identified what the physical risk exposure of the different assets all across the European region from all of the banks within their governance, what they have done is that they actually translated that into what it means to the financial impact. And based on the data and based on running the model from Moody's, what they have seen is that all across the climate scenarios, whether it's orderly transition, whether it's disorderly transition, is that they have seen a significant increase in the probability of default. So that would actually entail and actually show you that how each of these factors have actual or carry a financial weight. So it's not just something that is up and coming. It's not just, it's because it's a hot topic right now, that's why everybody's talking about it. But it does carry a certain financial impact towards a more longer term kind of horizon. So you can see here that from the use case, from the report that they have published, you can see the type of sectors that they have done the assessment on. So you have communications, you have water, you have gas, you have energy, and you have a wide range of sectoral implication, and all of them did experience a deterioration one point or the other. So this is why this is one of the key pressing themes that all of the financial institutions, not just in Asia Pacific, are actually working towards on. It's because we need to prepare, right? This is not like when you start to do the assessment, you can just be up and going and doing the portfolio monitoring like next month. This takes some work, and when we're talking about incorporating that into the framework, there is a process. So there is a journey that you need to go through and to be able to actually integrate that into the business as usual. So first things first, when we're talking about the risk identification, it has a few components. So one of the key things here, and one of the things that we always emphasize on, is the presence of data. So the presence of data is beyond financial statement and so on, right? So data is talking about here the physical risk aspect. What is your physical risk exposure to the different climate hazards? And then that also includes transition risk data. So what is the carbon emission and so on. And then at the same time, all of this information have heavy reliance on a company's disclosure. And we all know for a fact that a company's disclosure is not something that you would easily obtain. Especially you did mention, Pak David mentioned that bulk of your book is MSME. So you can expect disclosure for larger corporates, yes, sure. But for MSME or even SMEs in general, most of them, if not all of them, will not have this kind of information anywhere in their company. So what we have done in Moody's, because we recognize this as something that the financial industry would need help on, and quickly. So since we do have the information in-house, what we have done is that we have actually built a methodology so that we can help fill in that data gap. So that would essentially come up with a certain level of proxy that would get the bank going in terms of having a complete picture of your assessment and give you a starting point. So that is something that we have helped banks in the region, and even some of the regulators are actually using this particular methodology. And once you have this information, once you have the vulnerabilities, once you have identified this information, this feeds into the scenarios. So the scenarios would actually help you do the quantification all across the different type of climate scenarios. So whether you're following, one of the key things that are being followed by most of the regulators right now is NGFS, which is the Network for Greening the Financial System. So it will feed into the impact to the scenarios. And then once you have that result, that would essentially feed into adjustment of your credit models, that would feed into adjustment of your risk metrics overall in the bank, and of course, looking into a longer term type of a horizon. So this particular aspect can be utilized. So you have the data, you have the scenario, and this can also be utilized in the disclosure later on as part of your risk appetite strategy, as part of your strategy and decisioning, even for lending for pricing. So these output can be used in all of the components or all of the segments within the bank. So if you can see that the journey, it's not something that is very straightforward. There are a lot of work that needs to be done, and there are a lot of processes that needs to be taken into consideration. And maybe focusing more on the data aspect of it, when you look into an assessment and talking about transition risk, you are primarily leveraging on carbon emissions. This is one of the key component or key criteria in terms of measuring what is your transition risk. How much carbon footprint do you have as a company? But beyond that, right, when you're doing the profiling, when you're doing the assessment, you have to look beyond the actual emission itself. What we recommend is that you also will have to do an assessment and look at what the company is doing to manage their carbon footprint. Because they may have a very high footprint right now, but the next question there is, what are they doing about it? Do they have any strategy in place in terms of being able to lower down this emission by 2030? So let's say BNE have a target internally. So is it aligned with your strategy as a bank? And how can you partner with this firm to be able to actually work towards this common goal together? Because you are trying to have a sustainable business as part of the engagement. So beyond that particular emission itself, you need to look into the activities that they're doing, the strategies, and at the same time, do they have the capacity to actually able to implement this particular plan? Because looking deep into, realistically speaking, I can announce, for example, as a company, I can announce and say that, oh, this is part of my sustainable journey, and so on. But looking deep into it, I actually don't have the means allocated to implement such project, and I may not even have the track record. I don't have a previous experience of being able to do this. So it kind of defeats the purpose, right? So this is one of the key areas that whenever we advise the banks is that there are a few things that you need to look into and a few dimensions. It cannot be just one-dimensional referencing on footprint itself. So having said that, that also goes with the physical risk. So Indonesia is inherently a very lovely country and it's very rich in natural resources. But your flip side there is you are also exposed to different types of risks. So being a very big country, each of the sections in Indonesia will be exposed differently to different climate hazards. So one of the key things here is that you need to be able to measure them in a different level of granularity. That means when you're looking into the operational risk of a particular firm, for example, and they have, let's say, manufacturing factories located all across the country, you need to be able to identify how exposed are they to the different climate hazards. One may be more exposed to flood than the other. One may be more exposed to earthquake than the other. So this level of granularity is important rather than saying that, oh, okay, your physical risk is 85, but where? And by having identified those type of risks, then you would be able to see whether this particular company have any plans of mitigating that. Do they have any BCP in place to manage their operational risk and so on? And at the same time, looking at the supply chain and the market risk of this particular firm in terms of relative to physical risk. Because if, for example, I am actually doing the manufacturing here and then I'm exporting it elsewhere, but the country of sales that I have is actually very much exposed to, let's say, to hurricanes and typhoons. So is there any strategy that this particular company is doing based on that particular aspect and that different dynamics? So these are the kind of things that you need to take into consideration when you're talking about climate. When you're talking about climate risk and the level of granularity that you have to go to, right? And when you talk about ESG, on the other hand, so we said that climate is external, and when you talk about ESG, it's primarily internal. So looking into the company's strategy, looking into their leadership, looking at their results. So these are the dimensions whereby you need to assess what is the company doing, what is their activity at the moment, and looking into their overall plan to mitigate their risk to environment. And at the same time, the way that we are doing the assessment in Moody's is primarily on the dual materiality approach. That means we don't only look into what is the impact of the company, or rather, what is the impact of the environment to the company, but we also look at it vice versa. What is the company's impact to the environment? What is the environment's impact to the company? So it's a two-way approach in terms of assessing the risk of this particular firm. So it's not directly one-dimensional in nature. And when you look into the overall assessment as well, we do also do the assessment in terms of your alignment to TCFD. So it's very important because since this is the direction that the regulators are heading towards, it's very important that from the get-go, you're actually able to see whether is there completeness, are all the matrices being met, and is it up to the standard whereby the investors are actually expecting the reporting to be, and so on. So these are the kind of measures that you are looking at in terms of identification. Now, what you need to do is that, for example, if I correlate it to what we are doing with one of the largest banks in the Southeast Asian region, what we have done with them is essentially across 4 different pillars. So this is a methodology that we are helping them first to develop a roadmap. And we have developed the roadmap in terms of identifying what are their current gaps in terms of their risk management framework. Based on that particular roadmap, we try to identify where can we complement and what are the sections within the bank that needs to incorporate more in terms of the ESG and climate risk. Then after that, the first thing that we will do is do the risk identification or the profiling, trying to identify where your vulnerabilities are, generating heat map, and then identifying whether your portfolio as a bank, you are actually more exposed to physical risks, are you more exposed to transition risk, and so on. So we do this kind of assessment, and whatever data gaps that there would be, then we will complement that. And since we have the information, we can also provide a regional flavor into it. So it's not something that is globally made. Each of the country have a different dynamics, and that is something that is incorporated within the model. Now, having said that, the output of the risk identification is primarily talking about climate scenario analysis that would pave way into it, and then at the same time integrating it into their credit metrics. So when you're talking about scenario analysis, primarily it's at the end of it. It's at the portfolio level. But we wanted to emphasize that it starts in onboarding. It starts at the origination. It starts to being able to do this assessment in lending. So before you can actually lend, there is already a way for you to be able to do this particular assessment upfront. So we help the banks in the region to be able to do this by incorporating ESG in terms of the PD metrics, and then trying to quantify what is the credit impact from the onboarding process. So that means the output of that can actually help you in terms of pricing the loan, and then in terms of being able to influence the particular relationship with the company. Is this something that you want to head towards a better direction with, and have a communication with them in terms of the output. So these are the kind of use cases that we are actually helping them with. And then beyond that is also helping them with the stress testing, quantifying the capital impact. So for example, under the Pillar 2, are there any capital charges that would be required due to climate risk? So these are the kind of things that we are helping the banks in the region. And one of the larger regional banks, we're actually helping in terms of their compliance with one of the regulators' climate risk stress testing. Okay. Sorry, how? Do we still have time? Okay. So maybe just to touch point on this a little bit, like how do we do it, right? So within a bank, when you're talking about risk assessment, when you're talking about scorecards, when you're talking about the impact or incorporating ESG, what we don't want to do is there are actually different schools of thought. So some of the banks are more aggressive into really amending their credit models, but some of the banks are not very comfortable in doing that. So the approach that we have done here is basically in alignment to what the rating agency is also doing. But we have simplified it a little bit. So what we do is that we take the base internal credit rating model that you as a bank have, and then we can provide you with a standalone ESG assessment, which the output of that would become a credit impact score. Now, the translation of the credit impact score would vary from industry to industry. They would vary from obligor to obligor, depending on their asset size and so on. So a manufacturing firm with an ESG score of 50, let's say, will have a different output of a credit impact with a retail company that has an ESG score of 50. So that particular translation mechanism varies because they have a different type of factors, and there are different types of information that you need to take into consideration. And then what it does, or the output that you would essentially get, is an adjusted rating. So this particular adjusted rating would be, you will be able to define and identify what is the impact of ESG to the rating as of today, right? So those kind of information are something that we are working with a lot of banks in the region. And this is something that is adopted because there is a way that if, for example, your analyst is more close to a particular client, they would be able to define what kind of additional information this particular company can provide in terms of mitigating their risk, in terms of their ESG profile, and so on. And if you look into the credit rating agency perspective, you can see that for those highly energy intensive type of an industry, the way that the impact goes is that they're more on the negative side. So the type of exposure that they have a moderately negative effect on their credit quality versus a financial institution that is very low in terms of the carbon emission. So some of the rating agencies are primarily focusing on this front in terms of measuring the credit impact. So what we recommend is that you have to look at both of this angle together. So you have the transition and you have the physical risk aspect. And having said that, the output of those exercises that you will have will actually be focusing more on the scenario analysis and stress testing that you're planning to do. So what we have done is to be able to provide the clients out-of-the-shelf climate scenarios. And these climate scenarios are essentially aligned with the Network for Greening the Financial System. So that means we are actually able to provide you the different horizons for the next 30 years in terms of what is the impact to the company, to that company's profitability, or to that company's probability in terms of the different climate scenarios, whether is it under orderly transition, disorderly transition, or even in the hothouse or current policy scenario. So we have incorporated all of the different macroeconomic variables together with climate risk variables. So that means you do have the information about carbon prices, energy prices, and then you have all those financial factors and so on. Plus, you do have the physical risk information as well. So all of those combined can actually derive and come up with the impact to the financial, to the balance sheet or to the profitability of the company. So the creditworthiness will be impacted, and there are certain, if you look into, if I just go back to the TCFD disclosure from Bank of England, so this is kind of blowed up a bit. If you notice that there is a significant increase in their probability of default on all of the companies that they have assessed, all across the different climate scenarios. So this is regardless whether you are in a lower energy or a lower energy type of an industry, or you are high energy emitting type of an industry, there is a significant impact, right? And it carries that amount of risk that you need to be prepared for. So these are the kind of things that you can actually do when you're doing the scenario analysis, and that starts with you having the data, you having the core capability and the analytical tools to be able to do this type of analysis, and then that is the time that you can actually have the full picture. Once you have determined that particular impact that you have in the portfolio, what you can basically do is you can strategize, right? So is this particular industry something you would like to diversify on? Is this particular type of industry something that you would like to take a step back, or have something, some measures that you would like to be introduced to be able to manage your risk to this? So these are the kind of conversations that you can start on having once you have already have a full view of your portfolio. And maybe just, I think this is my last slide, looking into the credit impact. So what we have done here is that we have taken a baseline of companies that is under 1 billion in total assets. So all of the corporates within our data, and we have actually measured what is the implication to the probability or to the creditworthiness of this particular firm given a 10-year horizon. So the reason why we took 10 years is because this is something in between, because for under the disorderly scenario, it's kind of aligned because the policy would kick in with a 10-year lag. So we kind of took that as a baseline and then tried to quantify the impact on all of the sectors that has been summarized here. And I think one of the key thing that I would like to focus on is that since there would be an increase in the PD, the equivalent of that is that you will have higher capital charge. You can expect that particular increase as well, relative to the increase in your probability of default. And this is a conversation that is ongoing right now. And even the Pillar 3 disclosure is something that is ongoing also. I think in the European region, they're already starting to look into that. So these are the kind of metrics that the banks will need to look at and have a view on in terms of what are the risks they have in their portfolio and something. And yeah. Okay. And maybe as a last case for me, I did mention about putting ESG assessment, putting climate risk assessment in the forefront of the business. So this is one of the key use cases whereby we have developed the lending aspect and help them do that particular quantification. So there is a scorecard that is available for the banks to adopt, and that would primarily be revolving around key industries, and you're able to do the assessment from the front office. So that would help you to do the assessment to incorporate in your pricing, strategically do some investment decisions later on as part of your lending book, as part of your lending process. And at the same time, this could actually drive your conversations with your customers. So banks right now are key partners or catalysts to the corporate sector also, to be able to guide them into how can we push them to work towards the direction that we are heading. So the output of this would actually help improve your client's ESG profile, because you will have more information and this would help you gather more data. And then in the long run, you would be able to have a more rich type of an information to do your assessment in an iterative process. Right? So yeah, I think that's pretty much what I have, and I'm getting a prompt that I have 15 more minutes left. So,
thank you very much, Ms. Jo. Thank you very much for the very insightful informations that we have, and it really looks up for us to really look at how we process things. And honestly, I'm really impressed with regarding the models that you are creating, especially when you can factor in the climate risk into the calculations of the probability of default. Honestly, it scares me a bit when you said the probability of default will increase and also directly will increase the capital charge. And as long as it hasn't been instilled by the regulations, therefore we are still using the current model itself. But when in the future we have to factor in the climate risk itself, I think it will be a headache with most of the banks in Indonesia itself. And I have a lot of questions, honestly, regarding the ESG, but I would like to invite everyone in the room itself to, if you have any questions, please kickstart with the questions to give to Ms. Jewel. Okay, we have two at the back. Please.
Hello, I'm Riri. I'm from Credit Risk for SME and Commercial Division. I'm interested about the explanation about ESG scorecard impact for credit decision and loan pricing, because we are handling SME and commercial, and we are not that datas in SME segment is very hard to find. Any suggestion and insight from Moody's about how Moody's doing this for SME section, or maybe you can explain about the experience doing this in Bank of Indonesia? Thank you.
Thank you. That's actually a very, very good question. So this is something we always get. So data is a problem, right? So what we have done is that we all know that even though you have a very rich model to be able to quantify this, if your RMs does not have the data to fill in, it's actually moot. So what we have done in Moody's is that we have a methodology. So we have a model that could actually provide you with a proxy type of ESG score. So what the model does is that it would require you certain key input from the profile of the company that you are working with. So for example, that the key input there would be the company's location. So you can tell me whether is it operating in Indonesia, what is the industry that it is operating in, and some indication of its size. So when we're talking about an indication of the size, we're talking about what is the total assets of the firm, or what is the total sales, or even how many employees does it have. Now, what we do within the model is that when we are actually running this in the model, we complemented that with our own data. So when we do the assessment, we can actually come out with a very robust and rigorous recommended ESG score. And that particular ESG score is very close to as if a company did their actual disclosure. So when we're talking about, for example, the way that we have done that is that we have actually looked into the industry, for instance. So in the industry consideration that we have, we actually took over the NACE level 4, which means you have over 600 activities and sub-activities. So that particular level of granularity gives you a very good variation of an ESG score. That means a manufacturing firm of, let's say, a 1 billion USD type of a total asset may have a variation in terms of the ESG function because of the sub-industry and the sub-activity that it is operating in. And then when you start to layer that with the country information, with the specific country information, with the specific industry information, and with the bucketing of the sizes, you can realize that the output that you're going to get is essentially very close to as if this particular company did have a disclosure. So what we are doing with the banks in the region is essentially provide them with this recommended score, and then based on that recommended score, what the RMs can do is to kickstart that particular conversation with the client. Based on the information that you have at the moment, this is where you stand in terms of the ESG considerations, and then that would entail them or encourage them to try to provide more data because they wanted to enjoy certain benefits, certain perks in terms of being able to, because of a better ESG criteria. So that is typically what we are doing together with the scorecard. We have the recommended score, and then you do have the factors that the RMs can essentially adjust if, for example, they get more data, they get more information. Did that answer?
Thank you, Ms. Jewel, for the answer. Riri, is it confirm your question? Okay. Next question, please.
Hello, I'm Simon from Corporate Credit Risk Division. As I know, correct me if I'm wrong, some or even many nations nowadays may shift their energy mix due to the COVID pandemic or recent geopolitical issues. Indonesia itself use of renewable energy in 2021 was 11.2% of the total energy mix from its target 14.5%. From the ministry, we know that it was not because of the lower use of renewable energy, but the higher use of conventional energy during the pandemic. Do you think that we're still on the track? And then, as a bank, how can we keep encouraging our clients to implement ESG in their business processes? Thank you.
Thank you. That is a very tricky question, to be honest. So that is primarily driven by a lot of factors. So we can start with later on when Dr. Steve talks about the economics outlook and so on. We would actually see that this is the supply and the demand is driven by a lot of the global demand, right? And I actually read an article talking about the target of the renewable energy in Indonesia. However, due to the certain global conflict that has come out, it is very difficult for companies to exit like the more traditional like coal, for instance. It is very difficult for them to shift and to pivot. And it would take a lot of time. And I think one of the key considerations that you can take a look at is that because there has to be a certain balance, right? We cannot just say that exit this type of business that is not viable enough for the bank or even for the industry as a whole. So what we can say is that there has to be a certain roadmap or a plan that needs to be put into play depending on the type of activity and the nature of business of this particular company that you're working with. They can be a very high, let's say Adaro Energy. They actually have already started looking into investing their R&D in terms of the more renewable type of an approach. But overall, they wouldn't be able to exit coal in general, right? So there has to be an understanding and a roadmap and the type of relationship that you do have with these particular industries to be able to do the compliance to a more sustainable development. It would take time, some more than others or longer than others, but that's why it is important to note what is their strategy in place. It is very important that you as a bank understand what is the direction that this particular company is doing, that despite the fact that they are contributing to a very high carbon emission, they're actually doing certain steps to mitigate that. And some of the banks would actually provide a better pricing, let's say, due to the presence of this particular strategy. So some of the banks are more punitive in nature. So it kind of varies, and it kinds of an assessment of what is the appetite of BNE in general in handling this type of relationship.
Thank you, Simon, for the question. And we also have a question from the online participants. I will read the questions to you, Ms. Jo. From Pandu, what do you think the toughest investors or companies' ESG challenges in Indonesia? How is it compared to the global challenges in ESG implementation worldwide?
I think in Indonesia in particular is primarily, I think it's common. I think one of the key pain point is having the right data, right? So when the company does not measure this particular metrics themselves, it's very difficult for the banks to act on it. So that's why there are alternative data sources. There are certain methodologies that are being put into play. And I think the nature of businesses take play in terms of doing the ESG assessment as well, right? So one of the key things that we wanted to build upon is being able to get hold of the right data. And that is something that we recognized would not happen overnight. That is a continuous effort and a joint effort between the corporates themselves. That's why there are certain actions that are being taken by stocks exchanges, by the regulators, to be able to make sure to help these companies push these companies towards that particular direction. Because these key things are primary considerations to be able to have a very comparable type of information in terms of doing an ESG assessment. And like what I mentioned, this is something of an iterative process. As and when you get more information, you improve upon your governance, you improve your risk strategy in general. And I think this goes without saying, it's not just in Indonesia. This is very common even in the Philippines, even in Singapore, Malaysia, and even in the European region, whereby they are deemed advanced in terms, they are very much ahead of the curve, but they also do face the same challenges.
maybe 10 to 15 years ago, they faced the same challenges. Yeah. Okay. Like you mentioned previously, it's very monumental when we are facing the data collections in Indonesia itself. The second question from the online participants from Risma Bernadette. What is the impact strictly transition risk in our business as bankers?
Strictly as bankers for transition risk, I would say it's primarily revolving to your own books, into your own portfolio. Because you as an operational bank, if you just look into your assets, if you look into your branches, the level of transition risk that you have is very low. I mean, it's mainly operating offices, right? But if you look into your portfolio, if you look into your book, then that's where you would start to look into how exposed you are, strictly speaking, to transition risk. So if you are, let's say, palm oil. So talking about this particular industry contributes to a lot of factors. So there's a lot of there is a very high energy intensive type of an industry. There's kind of a lot of policies that have been put into place to try to control that, but at the same time not to really cut off the business, because that's one of the primary sources of income in the country itself. So it's looking into your loan portfolio, looking into your books, looking at the assets in general that you have as a bank. So looking into how you operate in general, but that would be maybe a small contributing factor, right? But the main contributing factor of that would be looking into your own books as a banker, basically.
Thank you. Maybe I will kickstart with also my questions itself. So what do you think is the primary opportunities provided? Like we said, the opportunities in Indonesia regarding the ESG implementation is very high. The area for improvement is also high, but the opportunities arises for the companies itself in Indonesia is also high. What do you think is the primary opportunities that can be leveraged for the companies in Indonesia itself?
That's actually a very good question. So when you look into ESG in general, one of the key drivers of that is that looking into the investments, right? When you look into the investment aspect of it, you look into how the infrastructure is being developed, that would essentially drive the social-economic growth of the country itself. So one of the primary opportunities is that, let's say, that the digitally implementation of your infrastructure in the country, and this would benefit and have a greater opportunity in terms of growth, in terms of productivity, and so on. And that would basically look into your contribution into the society. And then that's where your dual materiality would come in, right? So there are quite a lot of angles in terms of looking into the opportunities. And one of those key things is that you can actually look into specific industries. So when you look into your overall profile, you can actually look at specific industries whereby you can diversify. Because that is one of the key things, right? When you do know what are your key concentrations, you would actually see that, okay, this particular type of industry is something that I can tap on. So let's say real estate, let's say infrastructure, and so on. So it depends on how exposed you are already to that particular type of business. But that's primarily where your profiling would lie, right? So you would always look into it into the perspective of growth in terms of what this particular industry can do, and so on.
Thank you, Ms. Jo. And we are trying to chase regarding the how to generate the models itself, yeah. How the climate risk can be factored in the probability of default calculations. You have already mentioned that regarding the rigorous of the data collections is really important. What is your suggestion if we want to catch up with the data itself, or regarding to increase the data validity, to increase the validity of our model itself, so that it can factor in climate risk regarding the gaps that we have already had regarding the data collections, and what is the steps that we have to measure and to track if we can achieve the gap that we are focusing at this point?
First things first, I think we have to identify what is the operational approach of your model, right? So what are the factors that you're considering at the moment? And then what are the key considerations that you already have? So those are where your key gap assessment would lie into. And then based on that particular factor, you need to be able to identify how can the physical risk aspect come into play, how can the ESG factors come into play, or the transition risk factors come into play. So it's not very straightforward in nature, right? Because you need to be able to identify, is this something that you would like to touch the actual model itself, or would you operate it in such a way that it's more of an overlay? So there are certain processes that you can look into in terms of how you wanted to do the quantification upfront. So you can do that particular adjustment directly into the model, but that would entail data. Because you need to test it. You need to make sure that it works. You need to validate that model. So that's why, as much as possible, the recommendation that we do is that you can keep the current PD model. You can actually have the ESG assessment as a separate type of an assessment. And then based on that, we can have it calibrated based on the output, and then we can calibrate it by helping you with our data and what is the output of that particular adjustment, right? So it's primarily like an adjustment type of an approach, rather than readjusting all of the weights and your factors and so on, which would be very difficult in such a way to validate somehow. Because, like what we said, you need data for you to be able to do that.
Thank you, Ms. Ju. The third question from the online participants is from Ing Solihin. What kind of collaborations to overcome the problems related to the pandemic, climate change, geopolitical, economic growth, cybersecurity, and other global problems?
It's a very, very wide question. I think I would respond to this, but I think it's more fitting later on when we talk about the entire economic outlook. But the kind of collaboration that we as a bank have to do, or the entire industry?
We as a bank itself.
Okay, we as a bank with the companies that you're working with. So you as a bank need to look into it in a macroeconomic level, right? Down to the actual impact of the company. So you need to be able to consider what are the macroeconomic factors that comes into play. So like, for example, the Russian-Ukraine conflict that you're having, what are the implications of that to your own supply chain? And based on that particular information, are there certain measures that you will have to take? And then talking about cyber risk, talking about pandemic, there are quite a fair bit, and those are kind of emerging risks that you need to look into more than just credit. There has to be a way that you are already monitoring this at the moment to be able to start getting a sense as to how exposed you are to this type of emerging risk, because it's all encompassing. It's beyond credit, right? So there has to be a factor whereby it affects your operational as a bank. It would affect your reputational in a sense. So those kind of things, it boils down into communicating with the companies that you are dealing with. It's not very straightforward, I would say, and you need to consider what is the movement in the economy, not just looking into Indonesia alone, because you need to look into the entire relationship. So if you're dealing with a conglomerate type of a business, how does the entire global economy is actually impacting this particular company in terms of those different aspects? So there are a lot of things, and I think later on in the session that would be given much clarity in terms of what are those particular factors that you can look into, like inflation and so on.
Thank you, Ms. Jo. Is there any other questions from the on-site participants? If not, let me close with a question from myself itself. Mr. Darman, is it okay for me to ask another question? Okay. Because we already noticed that there are a lot of opportunities in Indonesia, raising the standards of the ESG itself. And also the implementation of the ESG itself is a really monumental thing that we have to participate in collaborations with everyone, the government, us as a bank as the intermediary, and also all the debtors and also the companies provided. And we are trying to also catch up with what we want to participate in the ESG principles itself. And looking at the scenarios that we have already mentioned previously, despite of the proxies and overlays on the model, the scenarios itself is driven from the macroeconomic variables, right? The macroeconomic variables itself, it's quite volatile when we are taking into a scenarios base. And what is your catch on having the specific macroeconomic variables which really accommodates the scenarios that really will be impactful in the real life itself?
Which variable? That's a very, very good question. So in terms of the macroeconomic, if we talk about climate variables first, and let's pick just the transition impact. So those are primarily driven by carbon prices. So you wanted to take a look at, because you are trying to lower down the global temperature down to 1.5, you need to be able to impose certain types of carbon price. And the longer that it takes you to start, the more punitive the carbon prices would become. And that would translate into a financial impact, right? Now, beyond that, carbon prices, you also have your taxes, you have the energy mixes, and so on. So all of these factors come into play when you're trying to do an assessment of transition risk. It's not directly volatile as per the global macroeconomic variables, because these are recommended by the integrated assessment model, right? So based on those, there are certain assumptions and projections that have been made until 2100, and those can be a starting point in trying to do the assessment. Then at the same time, when you're talking about physical risk, that particular aspect would come into what is your hazard in terms of the different in terms of the different climate hazard. What is your exposure to that? So that also has been done using peer-reviewed climate models. And those had been done and in projection to a very long-term kind of a horizon in terms of incorporating that particular risk when you're trying to do physical risk assessment. And then what you do is that you can actually combine. You can have a combined impact looking into both transition risk and physical risk. So the variables is one of the factor, but I have to say it's not just a factor. So there are quite a fair bit of things that you need to look into in terms of the climate variables, in terms of the macroeconomic variables, and even for example, the macroeconomic variables are actually projected in line with the climate scenarios. So this would follow the pathway as per what has been recommended by NGFS, for example.
Thank you, Ms. Jo, for the insightful these explanations and also very fruitful discussions. Hopefully, this can also give a benefit for all the participants, either offline or online. For this, I will close the first session for the ESG trends, and also I will give back to Mr. Darman.
Thank you very much. Can we give a round of applause to our two speakers? Thank you very much. So, Benny High Movers, I'm not the only one here who feel a bit thirsty and hungry, am I? So we already provide you with some refreshments, so please enjoy the coffee and also the juices. We provide some, options, healthy options, hopefully. We'll take a 15 minutes break, so we will continue the session into the second one, talking about the economic outlook. See you soon. Stay tuned. Thank you. Okay. Ladies and gentlemen, hopefully you have already enjoyed the coffee break. We would like to invite all of the audience to enter the main room and be seated because we are about to continue our session. Thank you. Once again, we would like to invite all of the audience to enter the main room, and we are going to continue the session with Market Outlook. Thank you. Okay, ladies and gentlemen, hopefully the coffee and juices are strong enough to make you ready joining the second session of the event. So the next up would be the economic outlook, and I would like to invite the General Manager of Enterprise Risk Management Division of Bank Negara Indonesia, Mr. Rayendra M. Goenawan. Thank you.
Thank you, Mr. Darman. Driven by the global economic conditions and also the circumstances surrounding us, I think this is a very good session when we are opening how the market outlook itself and rising all the geopoliticals and also all the challenges that we are facing at this point. And I think it's very insightful for us at this point to really have the experts who can share with us what is the market outlook, what is the opportunities, and what is the challenges that we will be facing. Our next distinguished speaker is Dr. Stephen Cochrane. If I misspell it, I'm sorry. Okay, thank you. The Chief APAC Economist with Moody's Analytics, leads the Asian economic analysis and forecasting activities of the Moody's Analytics research team, as well as the continual expansion of the company international, national, and subnational forecast models. Hope you enjoy all the events on the second session. The floor is yours, Dr. Stephen.
Well, great. Thank you. Thank you very much. Thank you all for joining us today. It's a very, very big pleasure to be able to be with you today and just chat really kind of informally about our outlook for the economy. Of course, there are so many uncertainties, so many shocks that have come along to the economy, shocks that we actually, as forecasters and modelers, have a difficulty with. that these shocks that are hitting the economy, whether it be the Russian invasion of Ukraine, the supply chain constraints coming out of China with zero COVID, earlier the U.S.-China trade war, you can go back farther to the lead up to Brexit. It's so difficult to really understand and how to factor into one's forecasts events that really have never happened in the past, or in the recent past anyway. So I want to share with you some of our thinking about how we take into account some of these surprises that hit us, and then show you how that factors into the economy, what we're watching for right now, and what some of the opportunities and some of the risks are. So my presentation is divided into 3 parts. I want to talk first a little bit simply about current conditions in the economy, and there are so many uncertainties right now, so much of my time will be spent in this first section. Then I'll talk a bit about the outlook, and I'm going to be rather near term in the outlook in terms of this year and next year. And then we'll wrap up with a few comments about risks and uncertainties in the economy as well. How's that sound? Okay? Yeah? We can do that? All right. Good. Okay. So part 1, current conditions. Let me just start with, I'm going to start at a very high level. We'll start talking about global conditions, and then we'll bring it down to Asia, and we'll bring it down to Indonesia, and we'll go from there. So this map has every country that we cover, and that would be every country that is not gray. Countries that are gray, I just don't have an economist who's following those countries. They're smaller ones. And this map shows where individual countries are in their current business cycle. If you think of a business cycle as being generally a country that moves along, it grows, it expands, and then ultimately you hit some wall, fall into a recession, then you have to recover and come back and grow again. And so that's what we refer to simply as the business cycle. And on this map, one wants to be either green or blue. Green is an economy that is expanding, that its total capacity, total production is at a peak and still rising. Or blue means it's recovering, say in this case, recovering still from the COVID-related recession of 2020 into 2021, still struggling to come back, but at least growing. And so, quick to note, of course, Indonesia is green. Indonesia has recovered. It is expanding now. It's in a pretty good position. One thing about Indonesia is that the social distancing measures, the shutdowns that happened during the pandemic were not so great here as compared to, say, in the Philippines, where it was very, very difficult and the economy fell much farther during the pandemic recession, or say Thailand, which also was shut down very tight for some time. So less of a hole to come out of. Indonesia's recovered pretty well. But almost all of Asia is either green or blue, and that is good. And that is meant to say that I actually think Asia and Southeast Asia in particular, notwithstanding all the risks and all the uncertainties of the near term, stands in a pretty good place right now for continued economic growth. Of course, we'll talk about what some of those risks are in a moment. Compare that to Europe. We have Europe mostly yellow, and yellow countries are countries at risk. We put much of Western Europe and Central Europe at risk because they're right at the core of the issues coming out of the Russia-Ukraine war, right? All their energy is provided by Russia, costs are up, there's a possibility they may have shortages of natural gas this winter. Lots of issues in Europe right now, and the highest potential for actually falling into recession, perhaps fourth quarter this year, first quarter next year, somewhere around that time. It's not what we're forecasting, but there is that risk there. In North America, we still look at the U.S. as expanding, although the economy is slowing down in the U.S. as well. The issue with the U.S. economy, of course, is that inflation is so high, and we know now already that interest rates are beginning to rise very quickly. The Federal Reserve is raising interest rates, and bank rates are following. So while the U.S. economy is still expanding, it's slowing. There's some risk, but less than Europe. So if I can rank the risks between Europe, North America, and Asia, I think the highest risks are in Europe. The next highest risks are in North America, and the third highest would be here in the Asia-Pacific region. So that's very broad. Country by country it varies, but a very broad assessment of current conditions in the economy. We've made some pretty meaningful changes to the economy because of the Russia-Ukraine war and the resulting upticks in energy prices and the supply chain constraints that have occurred. In fact, if on the previous map, the big red countries were Russia and Ukraine. Those are the countries that are in recession right now, of course, because of the war and the sanctions on Russia. We've had to make a series of adjustments in our forecast. The problem with being an economic forecaster, and I've been doing this for a long time, and you have to become comfortable with this, is that you're always wrong. Something always happens that you don't expect, right? And in a sense, this chart shows that the black dotted line going from the lower left to the upper right, that was essentially our trend forecast pre-COVID. We had recovered well from the global financial crisis. Banks were in pretty good shape around the world. Households had finally recovered. Housing markets were back in good shape, and it looked like conditions were good. Then what happens? COVID hits. Bingo. The economy goes down. That's, of course, that V shape on the economy there, and on the line there. Then we had a pretty good recovery for a while, although things slowed down a little bit, but we got sort of back on track, slowly catching up with that dotted line. Then we get to 2022. And what happens? And then we have the invasion of Ukraine, followed very quickly by the impacts of zero COVID in China, shutdowns in Shenzhen, shutdowns in Shanghai, in Jilin province, and so we had a sort of a double whammy in terms of commodity prices, supply chain disruptions, and just a general geopolitical uncertainty. So once again, in 2022, my line splits. The blue line is what we were forecasting prior to the Russian invasion of Ukraine, and then we had to bring that down. This is a real GDP growth, by the way, and we have a slower trend now with that green line of what now we're expecting. So prior to the Russia-Ukraine war, we thought that the economy would get back to where that dotted line was by about the end of 2024, 2025, right? The blue line and the black dotted line just about meet. But now it looks like it'll be another year or two. It might be 2025, 2026, before the global economy sort of gets back and can finally reset to where we thought it might have been all along previous to the COVID pandemic. So that's sort of a mea culpa that we never get it right, but at least we change our assumptions with each shift in the economic conditions. So what do we have to do recently? So again, so much of we have models which we use to project economic conditions. Those models are a series of equations that use historical trends to try to forecast, based on those trends, what the future will bring us. But now, more and more, we actually have to just make specific calculations and assumptions based on those calculations to at least look at the near-term outlook for the economy. So the latest change, and which is my button for the pointer? Is it the top one or the bottom one? Bottom. Top. All right. Now, how do I get it? There we go. All right. Very good. I'm not very good with technology. This is pretty high-tech stuff. All right. So May forecast, June forecast. May forecast, we thought that given conditions with the sanctions on Russia, that the global economy might lose 2 million barrels a day of crude oil. So we had to translate that into not only the impact of the loss, but how quickly that loss of crude oil could be made up by new supplies. And the new supplies, so the this part of the table, and I promise this is the only table that I'm going to show numbers, the only table where you have to put your glasses on to read these small little numbers, right? Okay. So these are the different ways in which we will which we will lose some production, and down here, this is where we may make up some production. Yeah, I'm really not very good with this. We do expect that there will be some additional supply from the United States. There's new investment in the fracking fields of Texas and Oklahoma and New Mexico. We expect that Saudi Arabia, the UAE, and other GCC countries will also increase production, as they actually have promised. Trouble is, now with the additional sanctions that the EU has placed on Russia and Russian oil, that we may actually lose about 2.8 million barrels per day. So that puts off that much longer into the future when we may get back to some equilibrium in terms of supply and demand for crude oil. Now, we do make some assumptions that there will be the higher prices that this is bringing along also generate a little bit of greater increase in supply. And so we do ultimately come back to an equilibrium between supply and demand on crude oil, global crude oil. But it will take longer. We initially thought earlier in the year that it might be in about now or maybe in the third quarter when we might reach a new equilibrium and prices would begin to come down on oil. Now it may be more like the end of the year before we actually get there, which means that inflation is going to be with us for a little while still to come. And that's, of course, the risk that almost the entire global economy faces. One of the positives about the, the energy economy is that it does look like that global crude oil price has peaked. If you think of Brent crude oil as the global standard, the price for Brent crude has been about $110 a barrel for the last almost month or so. Now, when the European Union approved the additional sanctions on Russian oil, it jumped up to about $120 a barrel, but it didn't stay there very long. It came back. So it meant that markets actually expected that, one, those additional sanctions are going to be difficult to keep in place, and two, that there's a little bit of less of a risk premium as there's an assessment, I think, that this is about as far as sanctions on Russia will go. There won't be much more that the Western countries can apply to Russia. So some stability in terms of oil prices, but it's going to take a while for them to actually begin falling. So that's a very fundamental assumption in terms of our forecast going forward and what it might mean for interest rates and for macroeconomic policy, particularly monetary policy around the world. Okay, enough of those numbers. I'll take this away. You don't have to look at any more tables. Let's just look at some charts. So I mentioned that the forecast for oil prices is a very important part of our broader macroeconomic forecast. And while we think we can estimate when we may get back to equilibrium, we also know that oftentimes we're just not right. And what we do is every month we update our forecast. We have a baseline forecast that we think has a probability of 50% of occurring. That's our definition of our baseline forecast. But then we produce every month a couple of upside scenarios and a couple of downside scenarios. So these are some of the scenarios that Jewel was talking about. I mean, we have also our climate scenarios, which is another piece of the products that we put together. But these are the scenarios that are often used, say, for IFRS 9 purposes by banks, insurance companies, and so forth. And this chart shows our baseline forecast for the Brent crude price, which shows some stability and then beginning to come down. But you can see that we have two scenarios. These are downside economic scenarios in which the Brent crude price actually continues going up to about $135 or even $160 a barrel. These are based on assumptions of producers not stepping up and producing more, and more sanctions actually being placed on Russia and so forth. It's not hard to create a narrative in which prices are higher. It's more difficult to create a narrative in which prices are lower. So you can see that the two upside scenarios, which actually have lower oil prices, they don't have much of a difference. It's hard to imagine how oil prices could fall any quicker. It's easy to imagine how oil prices could stay higher for longer. So that's one way we shape our near-term scenarios, our upside scenarios and our downside scenarios that many of our clients use to bracket the baseline forecast and to look at the risks on the upside or the downside. But roughly speaking, yeah, I mentioned, I think that Asia, the Asian economy is doing well, and the global economy, at least if there are no more shocks to the economy, and if we can manage these higher interest rates and higher prices in a fairly graceful way, that the economy can continue to expand. A couple of figures that I look at every month when they come out give me I think, a pretty clear idea of where the global economy is, and that's these two figures here. This is data that comes from a so-called CPB World Trade Monitor. This is data that actually comes from the Netherlands government. This is an agency of the government of the Netherlands, and they compile global trade country by country, and they compile industrial production figures country by country and release them. There's a little bit of a lag time, but this data now is through April, and you can see that it does follow pretty closely what I showed, what I described earlier in terms of economic trends. Both the world trade, which is the green line, and industrial production, which is the blue line, did pretty well. These are indexes. They fell during the recession, but came back pretty quickly, but then kind of faltered again in mid-2021 as we fought the Delta wave and then the Omicron wave, and there were many, many shutdowns around the world. But then by the end of 2021, as we were getting beyond that, and particularly as Asia was opening up, other Europe and North American economies had opened up sooner. When Asia began to open up to the easing of social distancing and domestic demand began to rise, you see those numbers go up again at the end of 2021. And we thought we were poised for a very, very good year in 2022 until, of course, the surprises of Ukraine and COVID reappearing in China worked to slow those numbers down again. So we can see that through April now, through April, the global trade has kind of leveled off, and industrial production actually has fallen. Most of that decline is in China and in Russia and Ukraine, and to a smaller extent in the rest of emerging Asia. I do think, though, that we're at the worst of conditions right now, and we are going to see these things begin to turn as we get the May data, June, and so forth. Particularly because the China economy is finally getting beyond its zero COVID shutdowns, and at least the global economy, the inflation is, I think, beginning to level off slightly. Supply chains are stressed again, but not nearly what they were back in the middle of 2021. This is an index that we create ourselves. This is our Moody's Analytics Supply Chain Stress Index. We create one for the US, we create one for China, we create also one for Latin America and for Europe, but I just show China and the US since these are the most critical. So since the middle of 2021 through today, the biggest stress on supply chains actually is in the United States. And a lot of that is just going right through the ports of Los Angeles and Long Beach, where ships still have long wait times, and empty containers and full containers are stacked and waiting to be either put on trucks going inland or put back on ships going back to China and elsewhere in Asia. The China supply stress index, not quite so high, and it is leveling off a little more quickly than is the U.S. one, as the ports around the Shanghai area and around Shenzhen, Hong Kong are easing up. The congestion is not so great. And you can actually see this in some of the export data of countries around Asia who trade with China. Indonesia won. China is the biggest trading partner of Indonesia. And exports have been pretty steady around this part of the world. And I take that as a very positive sign. The exports have been actually a foundation for economic growth throughout the pandemic period. Southeast Asia has really done very, very well in terms of managing to keep industrial production going and exports going as they trade with China, or as demand from Europe and the US has come back fairly quickly as well. And you can see it here. This is exports. I do a 3-month moving average and then take a percent change year ago. And you can see that the trend of exports sort of follows the path of COVID. Again, there was a bit of a slowdown in late last year, but a comeback early this year. April was tough because of the shutdowns in China. But for many countries, the exports have come back in May, and they've stayed fairly buoyant all through this period. And this is a critical assumption that I make for the regional economy, is that this will continue to be one source of economic growth for Indonesia and for Southeast Asia over the coming years. There is some risk there. If the U.S. economy and the European economies were to fall into recession, it would slow this pace, but I don't think it would be enough to knock it completely off guard. Particularly in China, I don't mean to spend a lot of time on China, but again, China is in a sense, the elephant in the room, right? It's the biggest economy in the region, and every country from Japan to Australia in Asia Pacific depend on exports, export or import trade with China. And you can see here that exports is the green line, imports the blue line. The green line hit a low point in April, but in May, it jumped up. Actually, it surprised most analysts that it came back as strong as it did in May, and we'll be getting a June read pretty soon on this data. And elsewhere, one of the other big economies, India, not quite so buoyant, but at least industrial production is beginning to pick up a little bit, and exports are leveling off. They've kind of come down in India, so a little bit of buoyancy there as well. One more chart on China. Here I have to apologize. The numbers look pretty squiggly, and the color differentiation isn't very great. I actually had different colors on here, but somehow when they got combined into our master deck, the colors changed. My apologies for that. But this is the China Manufacturing Purchasing Managers Index. This is a very broad survey of manufacturing conditions in China. A lot of questions are asked to manufacturers to give us what is a nice aspect of this is some forward-looking indicators in terms of export orders and total new orders. So you get a little bit of a look at future conditions through this. And the important point of this data is you always want to be above 50. 50 is the neutral mark. Above 50 is expansion. Below 50 is contraction. And so you can see that, first of all, in 2020, that was the pandemic recession. The manufacturing economy came to a halt in China. And then in April of this year, 2022, way over on the far right, another sharp downturn, but a comeback in May. And again, that comeback in May was very promising. We're not quite above 50 yet, but it's come back faster than I expected. There was a release for the June PMI today. I haven't had a chance to look at it. Anybody follow this data? Anybody look at the June PMI for today? Nobody? All right, I want someone to go out there and check it. Get on your phones and see what the June PMI was for China. Let me know. We'll come back during Q&A. I'll ask the first question, okay? So anyway, things looking a little bit better for China, except that the domestic economy in China still is very, very weak. And I show this with two lines here. The blue bar is retail sales, percent change year ago. And you can see March, April, May, very weak, down from the year before. Unemployment is up, consumer sentiment is down, all the regulation of industries, the shutdown of the after-school education programs, letting hundreds of thousands of workers go. It's a tough time. Property market weak. Even if there's a lot of stimulus that's pumping money into the economy, and that's what that green line shows, is the money supply in China, percent change year ago. China is very, very good at stimulating its manufacturing industries. It's not so good at getting stimulus down to small enterprises and to households. And that's one of the risks of the China economy that could keep it growing slower, and could be one aspect that could then add some friction to the rest of the Asian economy if China doesn't come back much faster. I mentioned exports. I won't dwell on this. This simply shows that exports not only are strong but have accelerated this year. This is exports on a percent change year ago basis, looking at January, the green bar, and April, the blue bar, and almost in all cases, April blue bar. This is not percent change year ago, pardon me. This is compared to exports at the end of 2019, pre-pandemic exports. And exports continue to rise and form a foundation for much of the rest of the region. Part of that rise in exports is because prices are rising for commodities, but because prices are rising for commodities, it's creating accelerated inflation here now as well. One of the strengths of the Asia and economy, including Indonesia, is that back when, about the time of the Russian invasion of Ukraine, inflation really was not a problem, a visible problem here in Asia. It was already a problem in North America and Europe. And so when all of a sudden the energy prices spiked after the Russian invasion, you had added inflation on top of the already high inflation in the US and in Europe. And that created a lot of fear, and the central banks starting to move in terms of raising interest rates to control inflation. Asia has had a little easier time of it because we've started from a low base this year, but it is accelerating, and that's what this chart shows. This is the consumer price index, a year-over-year change, and comparing January and May, and you can see how the blue bar, the May numbers are well ahead of the January numbers. So inflation wasn't a big deal here, but it is becoming important and something that central banks have to begin dealing with. Indonesia, you can see, at least is in about the middle of the pack. And I think this is one reason why Bank Indonesia has chosen to still hold at its low interest rates, the 3.5% rate for Indonesia right now. I do think that they probably will not be able to stay there for longer, that in their July meeting they may finally relent and begin raising rates perhaps at 25 basis point increments, kind of slow compared to where particularly the Federal Reserve is going. But it will be difficult to avoid the rising inflation and to avoid this increasing spread between interest rates here and interest rates in the US, and the impact that might have on the rupiah. And indeed, in Indonesia, there is a problem, particularly with inflation with food prices. Food prices have really jumped out. This compares the top line, headline consumer price, total CPI percent change year ago, and just the food component. And you can see Indonesia's in the same place, about in the middle. I leave it in the same rank, but you can see its food inflation, which is the blue, is out there with some of the other countries where inflation is the highest. So there are these issues arising that Bank Indonesia will have to begin dealing with. Some of the food inflation is imported. You can see here again, I apologize for the colors. These weren't the colors that I intended. But much of the wheat that is imported here comes from Ukraine or Russia. That's indicated by the colored lines here, the colored components of that bar at the top. and also even sugar. A lot of sugar doesn't come from Russia, Ukraine, but comes from India, and India has put some caps on its exports of sugar, so there's a chance that sugar and wheat and other imported commodities for food will continue to add to inflation going forward. So these are special issues for Indonesia that may continue to accelerate the pace of inflation in Indonesia. And I just show this just to illustrate the comparison. This is the blue line is the federal funds rate. That's the policy rate that the Federal Reserve controls. This was our June forecast when we expected interest rates to peak at about something like 2.8% in the U.S. and getting there pretty quickly. Already we know that it probably will be faster than that, because when the Federal Reserve raised its rate by 75 basis points a week ago or so, they said that there would probably be another 75 basis points coming up at their next meeting, and maybe another 75 basis points in September. That's faster than what we have here, which means that the so-called terminal rate, the rate where the Fed may take interest rates, will likely exceed 3%. We haven't settled on our July forecast, but it could be somewhere about 3.25, maybe 3.5% a terminal rate. There again, the faster the Fed raises rates, the more that central banks here in the Asia-Pacific region will have to catch up at least a little bit to keep those spreads from widening too much. If the spreads are widening, then you generally get capital flows out of the low interest rate countries towards the high interest rate countries. If capital flows out of Indonesia, then the value of the rupiah will likely fall as well versus the dollar anyway, and create some friction on the economy as well. And you can see that across the Asia-Pacific region, most central banks already are on what I would call the policy normalization track. Most have begun raising interest rates. Slow but sure, some faster than others. New Zealand is the fastest. They were first out of the block, and they have been very aggressive in raising rates. Others as well. You can see that I've put 3 countries on the right-hand side: Vietnam, Indonesia, and Thailand, along with Japan. I don't show because Japan is at 0. It would just show the 0 line. Those are the countries that have not begun raising rates, but again, I expect that they probably will very soon to be able to manage that spread between not only the interest rates between their own home currencies and the U.S., but between their home currencies and the other currencies of Asia as well. And the inflation rate, the blue line here, the light blue line, is the total inflation, but that gray line, if you will, that's starting to head up on the right-hand side, that's the food component of inflation. They're rising in terms of the target rate for Bank Indonesia, and they only have to go up a little bit higher and will begin exceeding the target rate for Bank Indonesia. And again, I think the Bank Indonesia will want to make sure that some containment of an inflation comes soon. So that's the sort of the fundamentals of what I'm looking at in the economy in terms of energy prices, in terms of inflation, in terms of interest rates, and trade. Very, very key components to watch for the economy. So let me show you what this means then for the outlook going forward. For this year anyway, this is real GDP growth. This is for 2022, so when we get to the end of the year and all is said and done, the growth rate for Indonesia, which is the 5th from the left, IDN, will be about 5%, I think. And one of the key factors is that I haven't changed that forecast much from what we were forecasting in February. This compares our February forecast with our June forecast. And again, this represents the stability that I've seen in the Indonesian economy, the steady recovery that has occurred. And again, up until now, the fact that the Bank Indonesia has held interest rates steady has been a stabilizing factor for the economy as well. The other countries, we've made more significant changes. On the downside, India and China, we have downgraded because of, in India, because inflation is the highest in India of any country. Their manufacturing economy has been very slow to turn around, and the RBI, the Reserve Bank of India, is raising interest rates quickly. I think that's going to put a bit of a brake on India. Even if it's still the fastest growing economy in Asia, we've pulled it down, the forecast down by almost a percentage point due to those factors. And China we've pulled down because of the deep difficulties in the domestic market in China, with the property market that has not begun to recover at all at this point, the consumers, weak consumer sentiment and consumer spending, and then of course zero COVID that's keeping, until recently, kept many businesses shut and has stopped a lot of consumer spending, very little leisure travel and so forth within China. And the country pretty well blocked off from international travel until I just read this morning that they're beginning to increase flights, and they're cutting the quarantine time in half for arriving passengers from overseas from 2 weeks to 1 week. So that's a step in the right direction, I think, for China, but still many roadblocks in front of the Chinese economy. You'll notice that on the left-hand side, Philippines, PHL, and Malaysia, MYS, we've actually raised our forecast since February for those countries. Malaysia, because it's a net oil exporter and gains from these high oil prices, and is actually still doing well with its tech exports to Korea, to Taiwan, and to China. And the Philippines has been turning around remarkably quickly after falling farther than any other economy in 2021 during its pandemic recession. One factor to think about, though, I mentioned our alternative scenarios that partly were dependent on different oil price assumptions. Well, these are the alternative scenarios for Indonesia as of our June forecast. That middle line, the line in the middle, is our baseline forecast, right here. So we're looking for pretty steady growth over the next 2 years or so. But you'll see that our upside scenarios are a little bit above the baseline, but our downside scenarios, there's much greater spread between the baseline and the downside scenarios. These have equal probability on the upside and the downside, but the impact on the downside would be greater because of the factors that we put into the downside scenarios in terms of continued high inflation. There'd be a faster raise in interest rates, a slowdown in the economy, and close to a recession on the downside scenarios. Now, these are a 10% probability, 4% probability on these two downside scenarios. So small probability from our own modeling work, but this is an illustration of sort of the difference between how good it might be or how bad it might be over the next year or two. Risks and uncertainties. Just a couple of things here. One of the things when I look at Indonesia, and I look at one of the opportunities for Indonesia, it is that Indonesia has been fairly steady and stable in terms of its policies that direct net foreign investment. We were talking a little bit about stability and policy earlier at the break as being really, really important. And I think this is where Indonesia has excelled in terms of attracting foreign investment year in and year out. And the Indonesia line here, again, the colors have changed. So, but Indonesia is this line here. This is FDI as a percent of GDP, pretty stable all the way across, and that's very, very good. But frankly, there's going to be a lot of competition for foreign investment across all of Southeast Asia and indeed across the rest of the world, because there is a clear indication that investors around the world are looking to diversify where they invest. It's not going to be China anymore, but it's going to be China plus some place else, just to diversify risks. And so there's a lot of competition across Southeast Asia between countries, but then competition with Mexico, Peru, Chile, Eastern Europe, to become the new manufacturing centers, new centers for technology, computers, programming services, and the like. And this is where I think any country, including Indonesia, if you're going to be a winner over the next, say, 5 to 10 years, every country is going to have to up their game in terms of making themselves attractive to foreign investment, infrastructure spending, education and training, stability in terms of a tax law, and so forth. These are all going to be very, very important. So that's why I titled this "FDI Needs a Bit of a Boost." For any country who wants to be a winner in a sense going forward, this will be a very key factor. And I'm going to end here. I bring this up still, although it may sound like I'm a little like I'm too late here, and that has to do with policy related to COVID and public health. This chart actually shows the vaccination rate. This is the percentage of the total population over 5 that's had any vaccine, fully or partially vaccinated. And you can see that all these countries across Asia, it's 70, 80, 90% of the population. It's a lot. Although Indonesia is at the lower end of this spectrum, there is some room for improvement in terms of still getting vaccinations out, like particularly to the older generation that has resisted, and making sure that there's enough immunity to survive the next wave, which ultimately will come. And to invest in public health services so there's enough capacity to manage those who may become ill and actually need hospitalization. My assumption and our assumption in our forecast is that this will happen. We haven't actually factored in another wave of lockdowns, even in China, because it's so difficult to understand when and where that might happen. But it could. And if a country is not ready for it in terms of both immunity and in terms of public health expenditures, that could be a weight on the economy going forward that could take away from all the good things that might be happening in the economy. I'll stop there, and then why don't we take some questions?
Thank you very much, Dr. Steven. It's very insightful information that is given to us. Really, the global economic conditions really is something that we are looking forward to it, and we see that how we can approach this kind of conditions and how to make the best prudent approach for us to face the forecast that is being made, not only from the economists and also the projections that we are facing on our portfolio itself. Thank you very much, Dr. Steven, and we will take some questions. Firstly, on the floor first.
Thank you for the great presentation. My name is Uke from Syndication and Corporate Solution Division. So my question is that I'm trying to have a holistic view from the 2 titles the event here, ESG Trends and Market Outlook. So in your opinion, where's the ESG factor in the market outlook, especially for Indonesia? Because as we know that some of our power plant for supplying the electricity is still based on the coal-fired, which is very important for our industrial activities. So what is your view, and especially for the global, or probably especially for Indonesia too? Thank you.
So the way I think about this is first of all, in what I talked about this morning or this afternoon, it's all fairly near-term trends. I'm really just trying to look and see what the probability is of us getting to the next 12 to 18 months without a recession before thinking a little longer term. But we do have to think longer term. And in fact, our forecasts go out 30 years, so we have to think about longer term possibilities for productivity growth and labor force growth and industrial transition and so forth. So those are all key factors, and ESG becomes a part of that. The way the ESG factors into our forecasts is in the longer term, in terms of the transition costs. Essentially, it's the transition costs that end up being a weight on the economy, and how those transition costs compare to potential productivity growth. And that's I think how one has to think about it in terms of how Indonesia might fare through this period of ESG transition versus other countries. There will be costs, and as you say, some of these costs will be high because these coal-fired power plants at some time have to be decommissioned, and there has to be a shift to renewable energy of one kind or another. We know that will not be cheap, and we're seeing it now facing it particularly in Europe right now as countries are even shifting from natural gas-fired power plants, which is only a temporary solution, back to coal. So they're taking a step back, and there will be a price to be paid for that longer term. The key to that then is, will growth be fast enough, and essentially productivity growth be fast enough so an economy can manage those costs and still continue to grow? Now, in a sense, this is where a country like Indonesia is at a certain advantage. Productivity growth here as an emerging market, and a fairly rapidly emerging market, is growing quickly, and productivity growth is growing. And that productivity growth is growing because of investment. That's why I brought up that issue of FDI. I think that's going to be critical in terms of adding installed capacity and through that improving productivity growth in the economy. It has to do with making sure that infrastructure investment continues to grow. I think one of the great things we're talking about government policy over these last 10 years and thinking leading up to 2024, we're having a little bit of a conversation during the break. There's been a very good, stable economic development policy over these last 8 years or so, and part of that has been the strong investment in infrastructure. And that, in my mind, that has to continue going forward because there's so much more that should be done to link the islands of Indonesia, to improve port capacity. One can compare, in a sense, Indonesia to Vietnam. Going back to that FDI chart, the line at the very top was Vietnam. Vietnam is the clear winner in terms of attracting foreign direct investment over the last 10 years. And for a number of reasons. One is just their location next to China. It's not that far away to link a supply chain between Vietnam and China. But another is that there are lots of ports along that long coast of Vietnam, so that you can avoid port congestion at any single location and avoid congestion at any single industrial park because of the plethora, if you will, of possible locations. Well, Indonesia, in a sense, has that same advantage because of it's not one coastline, but many coastlines around all the islands. And so the ability to get in and out of all these major ports is very important. That's where infrastructure comes in. And in terms of linking then the cities across the islands with appropriate highways and rail and so forth, key. So I'm kind of rambling on my answer here, but the important point in terms of managing these transition costs, which we factor into the forecast, is making sure that productivity growth through these various methods can continue to grow and offset those costs that not only Indonesia will face, but every country in the world will face. I hope that's answered your question in one way or another.
Thank you very much, Dr. Steven. I think before we go to the next question, I have another question from myself itself. As we all know that Indonesia has a really great opportunity to grow. And the growth itself is really the advantage that Indonesia have. Like what you said, we have a lot of coastlines, we have a lot of resources that we can maintain. We are also the producers of a lot of commodities. And I think this is really an advantage for Indonesia itself. But looking at the charts that you have already given, it really intrigues me to ask the questions, how can we benefit with all the conditions that is surrounding us, basically from your perspective as the economist in the global economic conditions, and what do you see the projections for Indonesia itself to take up the advantage that we have and to leverage it as our stand as a competitive advantage to also compete with the Southeast Asian countries. Thank you.
So a couple things in terms of sort of maintaining this growth and keeping up with the rest of Southeast Asia. One is working to encourage the shift in the industrial structure away from just being a commodity exporter and I know that's not the entire economy, but that's a big part of the export-based economy, and turning that into more higher value goods that then ultimately become exported. And I know that is currently a policy of Indonesia of trying to keep take the iron ore and the nickel and the other commodities that are produced here and not just ship it out directly, but create those secondary commodities or maybe even tertiary commodities, and then export those out at a higher value. That's what creates the productivity growth that the economy needs. But to do that, then there's got to be very, very clear rules in terms of investment, in terms of tax structure and so forth, setting those rules and keeping those rules stable. And I would argue that Indonesia, to a large degree, has done that, but there's been a lot of debate and some shifting and so forth. I would think about the recent shifting in policy towards exports of palm oil as an example of what one doesn't want to do. That there was a complete shutdown of palm oil exports, and then only in about 3 weeks that was turned around, and now it's a little more complex, and palm oil producers have to meet domestic market obligations before they can export. But that kind of uncertainty in policy would be a negative factor for Indonesia that I think, and I think that was kind of a clear example of a policy mistake, and hopefully, policymakers have learned from that. And I bring that up because, again, there's going to be a lot of interest amongst investors, manufacturers, service providers to diversify locations of where they locate. Indonesia is a great opportunity to attract some of those investors, but other countries will also be doing just the same thing, trying to get those investment dollars. And we've gone through a very natural experiment over the last 3 or 4 years of how well policymakers can identify problems, make a shift, and communicate that shift and maintain that clarity of policy going forward. As we've gone through COVID and the shutdowns and so forth, some governments have had a complete lack of clarity in what they are doing. Others have been much more clear. I think Indonesia actually has been one of the more clear ones. I know in Singapore, where I live, it was very kind of comforting to hear the Prime Minister get on the TV and be perfectly honest with the population of Singapore and say, "This is going to be tough." He says, "Don't have any illusions that we're going to get through this easily, but we're going to do what we have to do, and we're going to stick to it, and we're going to get through it." And they did stick to it. They didn't do much backtracking at all. Indonesia was pretty good about its policy making in terms of COVID restrictions and stuff. And investors will look back at the last few years and look at where some trust was built in terms of policy making, where that policy making was done in a clear fashion and in a direct fashion, and there was no uncertainty at all. And I would compare, say, Indonesia and the Philippines. Philippines never had a very clear strategy of managing COVID, and they didn't invest in public health, and they changed the rules all the time, and the economy suffered because of it. And Indonesia got through with much less of a downturn, and I think in a sense, if you compare those two different countries, it's just an example of how investors may take that experience and think about managing risk. So risk management, industrial transformation, attracting investment, and education and training for the workforce, absolutely critical. We were talking in the break as well about the resources of the vast population here, and that there are people out there living out in villages that have emerged to be winners in certain competitions and so forth, and allowing the best and the brightest from anywhere in the country to rise up and take the lead in whatever endeavor they choose.
Thank you, Doctor, for the insight. I think we have another question from one side, please.
Okay. Thank you. I'm Tia from Corporate Banking Division. Thank you, Stephen, for your presentation. It's very useful for us to, take into consideration when we revisited our strategy, especially for managing our loan portfolio. Maybe speaking of commodity prices, as you've mentioned earlier, so started from last year and still going on the beginning of year 2022, we saw that the coal price is, it's in favor. I mean, it's increasing, and of course, the companies that is operating in the coal mining business, and also the other companies that is included in the value chain of the coal mining business, benefits from this. They enjoy the higher price of the coal. I think my questions are similar from Mbak Uke and Pak Rayendra, but if I may, how long, in your point of view, this condition will last, and what is it for us that has to be, watch out for the rest of the year of 2022? And for the second question, it's among all the economic sectors, which economic sectors do you see will excel among the others for the rest of the year 2022, in correlation with also with the ESG trends going on worldwide. I think that's all. Thank you.
Okay, so two questions. One is essentially about commodities and commodity prices and where they're going, and the second was simply, can I pick a few winners or losers in terms of industries? Am I understanding that? Okay. So in terms of commodity prices, I actually think that the best of times are maybe behind us already, in that we have seen commodity prices begin to come in a little bit over the last a couple of months, particularly the last month or so. Of course, a lot of this has to do with the recession fears in the developed economies of the world, in Europe and in North America. And the recession fears, meaning less investment, less demand for manufactured goods, could mean less, resulting in less demand for basic commodities like coal and iron ore or so. That's a little bit speculative, because we don't really know whether there'll be a recession, say, end of this year, next year, say in the US or in Europe, but that's being priced in a little bit of the downturn in prices right now. Although of a more important note is potential demand from China. And of course, so much of the commodities that flow from Indonesia go to China. And this is one reason why I spent a little bit of time today talking about the China economy and the many difficulties that the China economy faces. China is ramping up infrastructure construction again as part of its stimulus to get the economy back on track. Infrastructure requires lots of steel, that requires lots, ultimately demand for coal and iron ore and such. So there's potential demand for that. Although I'm not so sure that stimulus will be as effective as it was, or if as the infrastructure spending in China will ever amount to what it was, say, pre-COVID, or I should say the period between the financial crisis in 2008 and 2019, 2020, when COVID hit. Because that's when so much of the Chinese economy grew, because this debt-driven growth, which funded lots and lots of infrastructure, which created demand for basic commodities. Those days are over in China, I think, as well. So we might get a bit of a temporary boost as China tries to push its economy through 2022, get it into 2023, and try to move on from there. But I don't think that will be a lasting trend, and so that takes some of the edge off of demand for basic commodities as well. So I do think that we may be beyond the peak on prices for those commodities, and that needs to be planned for in terms of potential revenue, either corporate revenue or tax revenue, however you look at it. Industries. A couple of come to mind. One, and this is common across much of Southeast Asia, travel and tourism is coming back pretty quickly now, quicker than I think we might have expected. The continued, there's still, the difficulty is that every country has different rules in terms of entering and exiting, right? And to be honest, a lot of people, I don't want to study ahead to know what it takes to get into, if I want to make a trip around Southeast Asia, I've got to understand 5, 6 different sets of rules. And that's enough for me to say, maybe I'll do that next year, not this year, right? But anyway, we see the airplanes are full, airfares are high, hotel rates are high in Bali now. And so it is coming back, and I think that's important because it creates a lot of secondary demand for goods and services in the economy, and a lot of support for small enterprises that support travel and tourism. So that's a positive. Financial services, the big improvement. This is movement towards fintech, towards digital. Transfer of financial resources digitally, not only within Indonesia, but cross-border transfers. And this is going to create a lot of potential for financial service growth and development. So it's a good industry to be in. And I also think, going back to exports, there is a potential to expand the manufacturing side of exports, to move up to higher value-added products, to go beyond what's here in Indonesia right now, to link up with other industries, whether it be the automobile industry or electronics or more basic metal products and such that go into either construction or manufacturing around the region. There's real potential there as well. So those are the industries that come to mind right now in terms of what I think there's a comparative advantage within Indonesia at the moment.
Thank you, Dr. Stephen, for the answer. And we will move to the question from the online participants. From Nigel Bramantia, maybe just a quick answer regarding the possibilities for the EU to produce synthetic oil to substitute Russian oil to mitigate the effect of the UN sanction against the Russia itself. Maybe from the reference that you got.
Well, here I wish I was more of an energy expert, and I'm not so sure the term synthetic oil, if that perhaps means biofuels, something like that. But that's how I'm interpreting it. But I may be wrong, and again, I'm not an energy expert. I'm not so sure the near-term prospects for making that kind of a shift is there. Maybe longer term, but my guess is that it just takes time for that shift in investment to take place and to be able to make those shifts in terms of production. But I'm going to stop right there because I just don't know enough about the energy industry, that piece of the energy industry anyway, to answer that question. My apologies.
Thank you very much, Doctor. And I think there is another question from the online participants. Whereas most of our concerns also regarding the invasion of the Ukraine and Russia, whether it can be prolonged. This is the question from Poppy, I think. Yeah, the next slide regarding whether if it is prolonged or regarding the invasion itself, how it will affect directly to the in-region economy, and also how can we take the advantages of the circumstances also.
Yeah, I think this is kind of a question on top of mind of everyone. When we were first looking at the invasion of Ukraine, it seemed pretty easy to think it was going to be a short-term effect, a month or two, and some solution would have to be found. And now it just doesn't look like that's going to happen, right? We're in it for the long haul. So there's an impact on the continued impact on commodities, particularly food commodities. I think this is where the biggest risk is coming in. It's easier to see where energy production can rise. We know where the potential capacity is in the GCC countries, in the US and so forth, in terms of creating more crude oil. as I mentioned. It's a little harder to know where we find alternatives to the wheat and the edible oils and such that come out of Russia and Ukraine. And even if there is a potential, there's all sorts of uncertainties. We don't know what the growing season will look like next year anywhere in the world, and whether it will be a good year or not, or how quickly other countries could come to the fore in terms of expanding their own production of grains and edible oil. And so this is where some of the potential for continued inflation, I think, is out there, is the uncertainty in terms of food prices. And this is really critical for Asia, particularly in emerging markets, in Indonesia, even more so for places like Laos and Cambodia, which are much lower income countries than here, because so much more of the household consumer bundle goes towards food rather than other things. So high food inflation makes a difference. It could lead to social unrest, as we've seen in Sri Lanka, for example, and beginning to see a little bit in Pakistan. So the opportunities are, how can Indonesia, perhaps domestically, work to increase its own food supply, either through either creating some efficiencies in terms of rice production or other kinds of basic food commodities that are produced here in Indonesia, and maybe more importantly, working very hard to diversify sources, import sources of food commodities and other commodities, so that one essentially, for the moment anyway, has no choice. Russia and Ukraine aren't going to be there for food products. So where else can we go? Can we go to Latin America and find wheat and food from Latin America, or from North America, or from other parts of Europe? So this again goes to the idea that one should be diversifying not only places of production, but places of importing goods, just so one can diversify one's risks as well. And then the risk, of course, is that inflation stays longer. Maybe we live with a longer period of higher interest rates than we might expect now. And I think financial institutions have to at least be ready for that potential of a higher interest rate environment for longer.
Thank you, Doctor. And also the second question is the second top concerns that we are also facing regarding the policies from China itself. And regarding the policies from China, will have a more deep impact directly in the Indonesian markets. What do you think, and what is your forecast regarding the prolong of this China policy, which can also impact directly on our portfolio?
Yeah, I don't see any changes occurring in the near term in terms of policy in China. And when we think of policy in China, it's actually multiple kinds of policy, right? It's what China is doing to put a floor under its property development market, what they're doing to re-employ all those who lost their jobs in the after-school education market that was shut down overnight. Whether China can adequately regulate the financial services industry without hindering the growth of financial services, which they still need to do very, very much, and bring the financial service industry more into a market-based industry rather than driven by command, so to speak. And then, of course, there's zero COVID that looks like, I think China will be sticking with zero COVID through the end of this year, maybe into next year, until they are either more comfortable that COVID is at bay, or perhaps that they can vaccinate more people and make sure that there's more immunity in China than there is today, and bring about using better quality vaccines, because the Sinovac and other Chinese vaccines have not been as effective as some of the other vaccines, the imported vaccines. So we have brought down our forecast for China. You know, the target rate that the Chinese government has put in place is 5.5% growth for this year, something similar. That's kind of what they have in mind for the next few years. We had brought it down once to 4.9. Now we're at 4.5% for growth this year. And I think that's actually a fairly optimistic forecast. That assumes that all the stimulus that is in place will have some effect in the second half of the year. And I do think one doesn't want to be too pessimistic about China. They are very good at managing policy and getting parts of the economy anyway going pretty well through fiscal policy and to a certain extent monetary policy. So the second half of the year will be very, very telling for China, and if they can get the economy back on track in the second half of this year, I think that'll be a very good sign going forward. But China does have to start working. I return to this idea of productivity growth that I think is so key for longer term growth. And for China, that's very important because of its aging population and its shrinking workforce. Its workforce actually is shrinking right now. I should say its labor force is shrinking right now. And so they really need to accelerate this transition of their economy towards higher value goods and domestic consumption and so forth, all clearly stated goals that the Chinese government has. And that has to stay on track in order to maintain the growth in China that they hope to achieve going forward.
Okay. Thank you very much, Doctor. Mr. Darman, do we still have time for another question? No. Okay. Maybe before closing the second session, this is also our personal inquiry. Yeah, maybe this is separate from the economic outlook itself, but I really want to know how do you make as you know, the forecaster, the model forecaster itself, as you mentioned, there are a lot of assumptions that has to be put in still when you are making the forecasting. What is your tips when you are making the fundamental assumptions, because it will drive how the scenarios will reflect on your forecasting?
Oh, wow. That's good. I'll be honest. It can be very difficult, and it's very easy to make mistakes in trying to understand the assumptions to make in the very near term. The longer term forecast actually is easier because you can fall back on economic fundamentals and fall back on how quickly the labor force is growing and productivity is rising, and one can make assumptions about long-term investment, capital spending, and so forth. But the near term depends these days on so many what we would call exogenous events, right? And so it takes a lot of very, very close monitoring and calculation outside of any model. You know, we sit down outside of we put the model aside for a while and just make these calculations on energy prices, make some calculations on where interest rates may have to go to have an impact on inflation, but where interest rates, how high they might go before they actually staunch the economy and stop the economy and make it fall into recession. In other words, what's that sort of narrow path on interest rates, the ideal path that slows the economy but doesn't stop the economy? And so there we go back and we look at historical trends and try to see where it's where that has gone in the past. But it does just take a lot of very careful calculation. I would argue that it's a very collaborative process. We have a team of 90 economists located around the world, and I've got here in the Asia Pacific region, I've got 15 economists in Singapore, in Sydney, and in Tokyo. We cover this part of the world. We've got teams in Europe, we've got teams in the US. And we get together, all 90 of these people together on Zoom calls every month to talk about these near-term assumptions, and they are wild meetings sometimes because we do have some disagreements. And actually, it's very nice. I mean, we welcome the disagreements. It's a very positive process that we go through. So everybody gets a voice. And everybody gets a chance to, in a sense, prove that their assumptions about whatever factor it may be are the correct assumptions. So you can't close your eyes to any potential pathway that certain variables may go. Be open to anything that may occur, and then come to a consensus and then take your stand.
Thank you very much, Doctor. So various perspectives and dimensions will enrich itself in the fundamental.
You said it better than I did. Yeah.
Thank you,
Very
Doctor.
good.
Thank you. So this is a really nice session regarding the economic outlook itself. And for the first session itself, we have the view on how the ESG and also the climate risk can do collaboratively with how we are progressing, how we grow, and also how we take advantage on the principles that the ESG have put in place, and how we can also collaborate not only us as the intermediary as a bank, but also how we can collaborate with the government and also all our debtors, because ESG implementation is a collaborative work, I think. Yeah, it's not only what the one silo stand can do all the work itself, but a collective work that has to be instilled with the same guidelines and the similar perspective itself. And very insightful on the first sessions that I took note is that when we are trying to strike a balance between the people, profit, and also how we can encourage the fundamental aspects of what we put in place in the ESG principles itself, we have to have the same mindset on the culture change. If we put it not as awareness, but also the urgency that we have to look into the ESG principles. And also in the second session itself, I took note on how we can leverage and catch up the gap that we are facing, where we have to focus on the infrastructure development, consistency on the policy, and also how we can leverage and also encourage people outside the fundamental of Jakarta itself, so that it can also increase the economic value of the people, where the baseline is the people itself. I think we have a great opportunity in Indonesia to really be prospectful, and based on what Dr. Stephen have also concluded, that all the projections is a projections that comes to what we have to face. And this will prepare us to have the prudent approach and to have the meaningful risk management perspective and also business side where we can collaborate each other. Thank you very much, Doctor, of your very insightful informations and also sharing.
My pleasure.
For this, I will close the session and I will give back to Mr. Darman. Thank you.
Thank you very much. Let's give a round of applause to our speakers. We would like to thank Dr. Stephen and also the team, because you just present a lot of insights for us, sparking some optimism, because of so many bad news about how bad or how ugly things can be in the future. But thank you for presenting both opportunities and also challenges. The next session would be the ceremonial phase. I would like to invite Ms. Jewel to the stage to get some token of appreciation from Bank Negara Indonesia to the Moody's Analytics team. All right, the documentation team can take place and begin to shoot some best pictures from the session. We really hope that this is not the end of our cooperation, but things can be better in the future, both for Bank Negara Indonesia and also the Moody's Analytics. Can we give a round of applause to Moody's Analytics teams and also Bank Negara Indonesia leader? Thank you very much. Okay. Cool. Very nice. I was hoping that things can be a bit longer, but we have to be very wise with time. So Hopefully, all of the Benny High Movers and all of the viewers can get some insights from our today's event. And hopefully this is, again, not the end, but only the beginning of all of the good things coming in the future. So, all Benny High Movers, I'll see you again on the next event. Let's learn together for Bank Negara Indonesia. See you.